Hello and welcome to Power Breakfast on Investonomics, an initiative by ICICIdirect. Joining us today is a very special guest, Mihir, CFO of Sterlite Technologies, to talk to us about the quarter gone by and the outlook for the company. Mihir, great having you on the show today. It's been a strong quarter for Sterlite Technologies, at least on profitability. That's grown multifold. Can you walk us through your earnings?
Indeed. We reported 1,309 crore rupees on the top line for the first quarter, which is about 49% growth versus the same quarter last year. But while we are reasonably satisfied with the numbers, it did have an impact of the third wave. The second wave of the pandemic-related shutdowns in the country. So it did affect some of our operations. So I would have liked and expected a better number, but for the pandemic. But if we leave that aside for a moment, I think the underlying momentum of the business is tracking very well on the top line. We have an order book of 11,200 crore as on the end of June this year, and we are all set to execute that through a large part of that through the rest of the year. Quickly getting on to the EBITDA numbers, we did a healthy EBITDA despite the dip in the top line versus our aspiration. We did 238 crore of operating EBITDA, and that was at 18.2% margin. So reasonably happy with how things are going. So far, so good.
Maybe let's just break this down between revenue and profitability, which we'll talk about in a minute. You said you've got a healthy order book. How much of that are you anticipating to be executed? And can you quantify that for me over the next couple of quarters? What I'm really trying to get at is what sort of revenue growth can we expect? Because the second wave is behind us. At least there's no bad news around the third Delta variant for now. So if business is back to usual, which it's seeming like right now, what sort of revenue growth are you working with currently?
Sure. So out of the 11,200 crore order book, about 4,200 crore is executable in this fiscal. So next 3 quarters essentially, okay. And the rest is beyond that. So our objective will be to execute all of it or almost all of it, unless something moves, which once in a while does happen. Having said that, there is also an element of book and bill in some of our businesses, which is the products business, the connectivity solutions business, where some part always are last minute orders and they form part of our book and bill. So typically, whatever is the order book, we end up executing more than that and booking revenues more than that. So you can add up and do the math. But if I share with you how I'm looking at it in terms of the growth, from here on, clearly the focus is that we should do better every quarter compared to the previous quarter. If you saw the last 4 quarters, so actually the 4 quarters of FY21, we had a good growth upwards. Every quarter was better than the previous one, and I would aspire to do that this year as well. And that's how you can add up the numbers and look at the growth.
And Mihir, any big orders that you're bidding for or that could be potentially in the pipeline? What I want to understand is significant investments have been made in capacity building. When can we expect that to show a meaningful impact in terms of your order book?
So order book, there's always a lag between order book and then revenues converting on the back of capacity, as you would know. From a capacity standpoint, we've started to increase the capacity, and barring this quarter, which was about 70% utilization, we've been quite high in the third and fourth quarter of last year. So as we keep building capacity, while we've announced new capacities, the build out of that is spread across a few quarters ahead, and we will keep increasing our revenues accordingly because the utilization rates are very, very healthy. Yeah, please go ahead.
Yeah. May you also break it down for us, right? Because a large part of your revenues also come from the international market. So now, while things in India might be moving slowly, a large part of the West, some parts of the Middle East, have already sort of gone back to normal in most senses. How is your international business looking? What sort of revenue targets are you working with the foreign market right now?
So, international business or non-India business versus India business is moving absolutely in the desired direction. When I say desired direction, is a large part we expect eventually over the next couple of years that about 60 to 70% of our business will come from non-India markets. We're
Wow.
already more than 50% of our business is already from non-India markets. And that despite the fact that on the system integration side, we've just about started. And that takes us to the acquisition we made in the UK. So let me zoom out a little bit. We have three levers of growth. The way we look at the business currently, there is the connectivity solutions business, which is linked to our capacities and the investment of capital in building those capacities. There we have announced new capacities in the UK and US, and that will kind of play out over the next 2 to 6 quarters of capacity build out and followed by execution, and therefore our revenues will go up from that category. The second category of lever is in the system integration business. We are clearly looking to globalize that business. As you may know, that the system integration business was largely an India business, and strategically we've decided to go outside of India, starting with Europe. We already have offices set up in the UK for going after the European market. Clearcom, which is a very good leading network integration company in the UK, is a great synergistic acquisition for us from the point of view that it matches not just with our strategic objective to get into UK and European markets in this business, but also the strengths that they bring to the table are very complementing. For example, we have ability to do large scale complex projects. So for example, we've done huge projects for defense, for Navy, for telcos in India, so on and so forth. We also have, through our other businesses, connections with tier one telcos in Europe already. I mean, we've been talking about BT and OpenReach in our businesses. So with that ability that we bring to the table, Clearcom brings to the table the ability to deliver, to execute in a seamless manner, and they have a proven model around it. They also bring supply side connections, and therefore both these entities and teams together will be a formidable force to play and expand in the UK and eventually the European market.
Right. I mean, I guess it fits like a glove in that case. But how have you funded this acquisition? And also, when will this start becoming revenue accretive? What already is from the first day?
So it is revenue creative. It's a approximately 20 million pound business and growing. It is EBITDA. It's a decent EBITDA, about 13 to 15%, which kind of fits in to our system integration EBITDA margins. So overall, I think from a P&L accretiveness, it is going to be accretive as from the word go. The objective is not necessarily or not only to rely on their revenues. I think the objective is to look at their capabilities and see how we leverage it along with our strengths and then grow at a much larger scale.
Right. What are your blended margins at right now, Mihir?
So while we delivered Q1 at 18.2%, we expect our blended underlying margins to be at about 17 to 18% through the year.
Okay, so that sounds pretty healthy. We talked about how profitability has jumped multifold this quarter. I think a large factor for that could have potentially been cost optimization, or the fact that costs have been low as we ran through the pandemic over the last couple of quarters. But as life does get back to normal, a lot of those costs, I assume, will come back too, right, Mihir? How will that sort of play out with regard to the outlook for profitability going ahead? Do you think you'll be able to maintain that sort of margins, profits going ahead too, despite the fact that costs may not be as optimized, rather?
So I'll make 3 points here. One is clearly the jump that one is talking about, or one is seeing. Our EBITDA has jumped 82%
Yeah.
versus previous year. I must be candid. Part of it is because of the low base. Last year's pandemic impacted quarter was very low on profitability, and therefore we are getting that growth optical benefit, if I may call it that. Second point I'll make is yes, even with some of those costs coming back, I mean, travel may be one such cost, etc. The underlying margin, we believe, will remain at 17-18%, and we don't see a disproportionate costs coming back. There are a few specific categories like travel, as I mentioned, where costs do come back, but most of the other costs are more permanent in nature, where we've optimized for efficiency rather than a short-term plug. Third point, and an important point that I'd like to make here on the cost side, is we have made sure that in our business, which is a tech business relating to the telecom industry, of course, but a tech business, we don't take our feet off the gas on research and development, R&D expenses. Our R&D expenses today flow everything through the P&L, and therefore in the EBITDA you see an impact of that. We want to continue to invest. We've said we'll invest about 3% of our top line in R&D, and that's something that we will continue. So a mix of all of this, these variables, costs coming back in some but not coming back in some other lines, R&D investments certainly kicking in, all of it factored in, we still believe that 17 to 18% EBITDA margin is very, very doable.
Right. Mihir, any fundraising plans?
Not on the horizon. I suppose you are referring to the resolution that our board passed,
Yes.
and the intimation we sent to the stock exchanges. It was an enabling resolution. We have gotten the exact same resolutions passed for the last many years, except the last year. And last year also it was not passed because we did a buyback, and therefore there was the restriction on that. So at this stage, it is an enabling resolution that we've had on our approval for the management team to decide if and when required, and that's relating to that. If and when we have plans, we'll certainly talk to everybody.
This recent acquisition, Mihir, that was made, how was that funded, and are you looking at any future acquisition as well, any sort of inorganic growth on the cards if you're looking to expand aggressively internationally, any synergies locally that might be on your radar?
So this acquisition, to answer the first part of your question, we've taken a debt for funding this. That was the most efficient way to do this. Of course, we've part funded it through a small amount as a part of the debt requirement or covenant, but it is largely debt funded acquisition. And the way we look at this is that typically on all our acquisitions, the operating entity would pay off, or the accruals from the operating entity would manage to pay off the debt that has been raised for that acquisition. And we've been reasonably successful on that front. Regarding our overall inorganic growth strategy, the way we are looking at it is that we do not want to buy revenues or buy growth levers through the inorganic route. We have either bought capacity in the form of Italy's manufacturing unit, for example. Metallurgica is what we acquired in Italy, and that was a capacity buy. Or we've bought capability buys, which means anything unique that we don't have or that we need. Clearcom UK is a classic example of that, where we realize that they have capabilities which will be useful in our growth process. So at this stage, I don't see any significant gaps in our capability. If something comes up in that category, particularly on the 5G side, on our wireless solutions, access solutions business, then maybe. But again, nothing on the horizon here. Our underlying businesses are all set to have an organic growth itself, and that's where we stand today.
What is debt on the book stand at Mihir right now?
It's north of 2,600 crore at the end of June. While we're not required to publish the balance sheet, but we are sharing this very transparently. So it's north of 2,600 crore.
And there are no plans to sort of retire part of the debt or to sort of build onto that, right?
Well, as of now,
if you've got that approval to raise that money, I'm just trying to put the dots together. Could there be any sort of fundraising that could potentially be used to reduce debt on the books?
Yeah, in theory, yes. In theory, yes. But at this stage, there are no such plans or thoughts. I think as we go ahead, and if there are plans, we'll certainly talk about it. At this stage, it's just an enabling resolution for us to keep all the options open, all the flexibility open. I think what we're committed to is by the end of FY23, the fourth quarter of FY23, which is about 7 quarters from now, we should be at a net debt to equity ratio of 0.5 or less.
Okay, so that is, of course, what the company is working towards by the end.
Absolutely, and we'll see. We're keeping all our options open in terms of how much we get from accruals, what are the internal profit generation and cash generation from there, working capital reduction and cash generation through that. So all those options are on the table, and we are on it.
Right, Mihir, great talking to you. Thanks for that perspective. Good to know that Sterlite Technologies is doing well. And of course, good luck with business going ahead. Thanks a ton.
Thank you very much, Samina. I appreciate it.